To start writing and recording accounting entries, correct classification of items being transacted is the first task, followed by applying the rules of debit and credit. In this video, we shall attempt to do the same. Hello friends, welcome to a new video on Hamsa Accounting. The meaning of main terms of accounting, that is assets, liabilities, capital, were clarified in earlier videos. Do watch those videos for more clarity on the basic accounting terms. The learning outcome for this video is to first get familiar with some commonly occurring terms with their respective classification, followed by understanding the steps needed to be followed for entering transactions in the books of accounts, and finally to explore the rules of debit and credit that will provide the solid foundation for correctly recording financial transactions. The list shown here displays the name of some assets that feature more frequently while recording accounting transactions. Land, building, furniture, machinery, fixtures, and plant are acquired by a business entity for long-term purpose to generate income for business. So these are regarded as assets. A fixture is an equipment or furniture which is fixed in a position in a building. Plant consists of machinery, building, and equipment at a particular location that is used for production of goods. Goods or stocks are items which a business acquires for further processing or for resale during the same year. For example, cotton is a good for a textile manufacturing unit, or copper is a good for a business unit producing wires and cables. All items mentioned here are explained in detail under the videos of basic accounting terms. I will request you to watch those videos if not seen already. Some examples of income, revenue, and expenses are shown here. For example, discount allowed by the firm. This is regarded as an expense because the firm or the business concern has extended discount to the third party, and thereby it has received less amount of money or less income. Therefore, it is regarded as either an expense or a loss. The opposite is true for discount received by the firm. This is an income or gain because the firm has received a discount from third parties. Other examples of expenses are salaries, rent, depreciation, and interest. On the other hand, rent received or interest on investment received, these are regarded as income. The list of liabilities is given here to quickly recall the detailed explanation given in the video of basic accounting terms, long-term liabilities, and short-term liabilities. Now let us focus on the main theme of discussion for this session. Items under all business transactions can be grouped in 5 broad categories. Millions of transactions occur in a variety of industries and sectors. But the interesting part is that all the financial transactions occurring in any type of industry with different products and services can be grouped in just 5 classifications. These are assets, liabilities, capital, expense, and income. The entire study of accounting revolves around these 5 basic elements. The steps that one needs to follow for recording financial transactions correctly is shown here. If these steps are meticulously followed, then any given business transaction can be correctly recorded under financial accounting. The first step is to correctly identify an item under the 5 broad categories. That is, to identify whether an item relates to asset or liability or capital or expense or income. This we have explained in the first part of this session. The second step is to ascertain whether the transaction increases or decreases the item. Just to take an example, a tailor obtains a bank loan of rupees 20,000, and with that money the tailor buys a new sewing machine. Now, the bank loan is a liability because the tailor will have to return money to the bank at some future date. So, we have classified the loan as liability under step 1. Since the liability came up only after borrowing money from the bank, therefore, due to this transaction, the liability has increased. Hence, under step 2, we have correctly figured out whether the transaction has increased or decreased the item. The item in this case is a liability. The other part of the transaction is the tailor bought a new sewing machine. The sewing machine is an asset for the tailor because it will help her to earn money by making a variety of dresses. Again, under step 1, we have identified the item as an asset. The buying of sewing machine increased the value of asset in the tailoring unit. Therefore, under step 2, we have figured out that as a result of this transaction, the value of asset has increased. After these two steps, we will have to follow the final step, which is to apply the rule of debit and credit. Now, let us understand the rule of debit and credit. Till now, we have learned that all transactions can be grouped under 5 basic categories. These are assets, expenses, liability, capital, and income. We also know that because of a transaction, the value of these items may either increase or decrease. Now, any increase in asset is debited in the books of accounts. Or we can say that increase in asset is debit. Conversely, any decrease in asset is credited in the books of accounts, or we can simply say that decrease in asset is credit. Remember, we are discussing the rule for debit and credit, and we will have to remember these rules. The rule for expenses is same as that of assets. Therefore, any increase in expense is debit, whereas any decrease in expense is credit. Thus, whenever expenses increases in a business, we will debit the transaction or debit that expense account, and whenever expenses decrease in a business unit because of the payment of that expenses, we will regard that expenses has decreased and therefore we will credit the expense account. For liability, capital, and income, the rule is just opposite to assets and expenses. Hence, any increase in liability or capital or income is credited in the books of accounts, and any decrease in liability or capital or income is debited in the books of accounts. So these are the rules for debit and credit. This is the fundamental rule of debit and credit that you will have to remember all throughout in order to correctly and flawlessly record transactions in accounting books. If we recall the example of the tailor who bought the sewing machine with the help of a bank loan, we can see that sewing machine is an asset and the bank loan is a liability. The transaction increased both asset and liability. So, if we apply the rule of debit and credit, we will have to debit sewing machine account because sewing machine is an asset and any increase in asset is debited in the books of accounts. In addition to debiting sewing machine account, we will have to credit bank loan account because bank loan is a liability and any increase in liability is credited in the books of accounts. I hope the steps given here are clear. In the next few videos, we will apply these steps for different types of transactions. And after we do so, that will further increase our understanding of recording transactions in books of accounts. For the time being, please remember and try to memorize the rules for debit and credit. Thanks for watching. Please like and share for more such videos.